Hello and welcome to another episode of the Real Estate Investing Club. I'm your host, Gabe Peterson, and this is the place investors go to gain actionable advice, learn about current market trends, and hear war stories from other professional investors out there in the field today. Before we get started, I have two quick housekeeping items for you. First, if you like this episode, we would very much appreciate a like, subscribe, and share. It is the best way to support the show and keep it running far into the future. Second, if you're a new investor looking to get started in real estate or an experienced investor looking to take your investing to the next level, I've created an ebook just for you that will cover how to find deals that are actually deals, how to finance those deals with little to no money down, and how to exit those deals for maximum value. On top of that, I throw in an insane amount of free bonuses that you'll have access to once you buy the ebook. All I charge is our admin costs to keep this show running. So if you're serious about real estate investing and want to create both active and passive income as an investor, head on over to the website at therealestateinvestingclub.com and click on the button that says get the ebook in the upper right-hand corner to grab yourself a copy. With that said, let's dive right in. Today we have a very special guest with us, ready to drop some investor knowledge on you. So buckle up, grab your pen and paper, and enjoy the ride. All right. Welcome back to another episode of the Real Estate Investing Club. Today we have with us Dave Holman. Super excited to have him on. Dave grew up in Maine, studied green building and environmental technology at Carleton College before spending 4 years in Bolivia, co-founding a chain of camping stores. I love that. It's a great story to start. He got his MBA in sustainable business and started real estate investing as a passive investor in 2011. All the while, he built a portfolio of rental properties, which has now grown to 94 units. Dave quit his day job in 2019 to be a full-time commercial broker, syndicator, and owner of his company out there at Katahdin. I'm butchering that one. I'm sorry. Property management. Dave, thank you very much for hopping on the show. How are you?
I'm doing great. And you'll be able to pronounce it well if you ever hike the Appalachian Trail, because Mount Katahdin is the northern end of the Appalachian Trail. So that's where it gets its fame.
Katahdin Property Management. That, it should have been an easy thing to say, but my brain is all scrambled today. Awesome. Well, hey, thanks for hopping on. It sounds like you've listened to the episode of the podcast before, so you kind of know how this goes. I want to hear your stories. We always start at the beginning of the journey because that's where, a lot of people listening and watching, they're at that stage. So take us back to the beginning. How did you first get started in real estate investing in the first place?
Yeah, thanks. So grew up in Maine, kind of middle-class upbringing, went to public school, never really had family doing real estate investing. Similarly, in college, I managed to get through it with only taking one econ class, and was into green building and design. Thought I might become an architect, but I had met a young woman in Bolivia when I was studying there, and we had struck up a relationship. So I went back down to see where it was going to go, and we hit it off and traveled together, and realized there was this unfilled niche where you couldn't get camping gear or Lonely Planet guidebooks or maps or anything like that. So we started a chain of stores called the Spitting Llama Bookstore and Outfitter.
That's an awesome name. I love it.
Just something to do together as we were dating, and then got engaged eventually, and we're now married with 2 kids. And so those businesses grew, and I had that kind of entrepreneurial, spark, as did she. So we started 2 other outlets. We had 10 employees, and I had this spider web of Excel spreadsheets that I didn't know if I was doing it right. No one had taught me how to, run a business before. And it was complex. So when we finally came back to the United States in 2009, I thought it's a good time to, learn accounting and go to business school, which I really enjoyed, having some practical experience behind it. And I always realized, as an entrepreneur, that renting, your rent is kind of like burning up money, and it's probably your biggest expense. Certainly in Bolivia, it was. Labor, was a lot cheaper there than it is here. But it didn't. I always thought about, geez, if I could buy one of these stores, then I'd be paying only a little more than my current rent, but I would actually own it. I could do whatever I want to it, and a lot of what I'm paying, I get back someday, because I'm building equity, in an asset. So even just intuitively, I was interested. But it was in 2011 when my best friend from Carlton approached me with a private offering because they were building a 100-unit apartment building in Minneapolis. He was working with developers. He'd already gotten his architect degree, and they had a syndication. And I had no idea what this was. It seemed, sketchy to me. I was like, what, 20% returns? Like, I'm a stock market guy. 7 or 8% is pretty good. Like 20 sounds like a scam, but I trust you with my life, and it all sounds real. So even if it's only half as good as you say, what the heck, let's give it a try. And I gave him a big chunk of the little savings I have or had at that time. And, they went ahead, built a building from the ground up, rented it out. And I started getting, dividend checks and quarterly reports and learning about it as a passive investor. So I kind of started, flip-flopping passively, and decided to try out an active investment in 2013. So my family and I bought a single family home in a small town in Maine right near where we live. That went good. So did another one in 2016, just kind of starting slow. And then that really was when I got excited because my wife had gotten pregnant with our first child. I realized that, I worked in nonprofits, so I wasn't earning a huge salary with my MBA, and decided I needed a side hustle. So real estate became it. And I started listening to podcasts like yours, reading every book I could get my hands on, and very quickly went out and got a 3-unit building that also had a commercial unit in the bottom and then 2 apartments on top. So that got me aware of mixed use, triple net leases, things of that nature. And from there, it was kind of off to the races. I started finding good deals and partnering with investors to buy those. And pretty soon I had, over 30 units and a full-time day job and fundraising at Bowdoin College, and realized that I kind of was ready to make that jump. I'd been passively and actively investing for a couple of years. My side hustle had grown to the point where, I was, managing dozens of units and needed to, pick one or the other. So I got my broker's license, became a broker as a way to get some extra transactional income because my passive income was coming, but it wasn't yet like, okay, let's just retire and I don't need to work or whatever. I wanted to be, plus I love, working and helping other people. So I wanted to be active, and started doing my own syndications, with friends and family, people that, I'd known most of my life, and that's grown now. We just completed our 3rd syndication, and, my network has expanded quite a bit from that. So, and then I started my own property management company with my best friend from the MBA program as well, because the quality I was getting before was just kind of substandard. And when you're used to getting, A grades in class, you really want your properties to be getting A grades and not be languishing vacant, for weeks or months at a time with no good explanation. So I had to take it in-house, and that's been a great decision, a lot of fun. And we've now expanded to 3 employees and having a lot of fun with it.
Awesome, man. I love it. And I love how kind of almost meandering your path is, because it seems that is reflected in so many guests who've been on this podcast. They start with one thing, goes to another thing, and before they know it, they have, 93, 94 units, and they're a broker, and they have a property management company and all these things. And it all started with your camping store down there in where was that? That was Bolivia, correct? Or
Yep.
Guatemala?
No, in Bolivia in South America.
Bolivia, I love it. So yeah, great story. I love that you got started small. 2013 was your first single family, and then 2016 your second. So you had 3-year period there before you really started making headway into syndications and such. So you have this breadth of experience. Let's hear what have been the major transitions that you've kind of run into as you've progressed through your career, starting from the single family and then now into syndications. What were the biggest lesson that you kind of took there?
Yeah, I had originally thought, man, if I can just buy 1 house a year, in 10 years I'll have 10 houses, and that'll be great. And if I'm earning, $100 or $200 from each of them, that'll be $1,000 or $2,000, a month of extra income. And if I need to send a kid to college and one of them's paid off or close to it, in 15 or 20 years, I can sell it and do that. And that was a pretty simplistic, arithmetic way of growth and thinking about growth. And the more podcasts I listened to, and just studying this, really economies of scale in real estate. and there's leveraging, other people's money and time and talent to build a team, and it's not wrong to work with other people. It's actually, you'll go a lot further, if you work as a team and do kind of bigger projects. And so that was the focus I had going forward, is how can I kind of grow? What's the next logical step? But sometimes, it's good to almost stay in your niche and not get out over your skis. I had one project where I had, this $1 million building under contract that needed another 3 or 4 million of work. We were going to use historic tax credits, and it was an incredibly complex deal. This was back in 2018, but it would have been opening literally right in the beginning of the pandemic in 2020, a 2-year project. And I decided, right after 4 months of due diligence, a lot of chase costs and architecture costs, to back out with 48 hours left before my earnest money went hard, because I just didn't feel right about taking investors on a 2-year journey where the best case scenario was like an okay profit. And there were a lot of worst case scenarios where I was in deep trouble. And so there were too many unknowns with that kind of project. And so I just went back to what I knew: value add, residential and office commercial real estate. And I've been very well served by doing that. And I now, getting into more development type of things where we're building new units and doing, more structural modifications of buildings. And I may get back to historic tax credits and, multi-million-dollar gut rehabs. But the amount of variables you have to control for and the length of time it takes you to profit are very different. It's not for everyone.
Yep, absolutely. And you said 2 things in there that kind of popped out to me. One was the tax credits. There's a lot of hidden benefits out there that many people don't understand, especially when you're doing specific types of development that you get as a benefit in return for doing that action. So what are some, taking the perspective of the Dave who had just started, what are some things that you kind of learned along the way when it comes to tax credits that you didn't understand in the beginning?
Well, there's a lot. I think the primary lesson, the listeners should take away is that tax credits are icing on the cake, not the reason to do the deal. So if you see a so-so building, but it's in an opportunity zone, that doesn't mean, jump all over it. That means maybe if you can make it work without the opportunity zone and it is a good deal without it, all the more reason to be serious about taking it on. But none of the tax credits are totally transformational. There's no free lunch. Even historic tax credits, which can be huge. In Maine, there's a state credit that's quite generous, and then there's a federal credit. You combine the two, you get a 40% tax credit on almost all of your renovation hard costs of the materials and labor, and the soft cost of the architecture and engineering. 40% rebate essentially with taxes, but you have to work really hard to get it, and you have to pay very expensive consultants. And you're often doing projects that would never in a million years pencil without that extra 40%. So you're not necessarily having a hugely highly profitable development just because you're using historic tax credits. It may just be the only way to get something to even break even. Yep. Because these are often vacant, derelict buildings that are more expensive to develop than a vacant lot. So it's a great program to save historic buildings, to revitalize communities, but it's not for the faint of heart. It's for people that really love paperwork and complexity.
Yeah, me and some partners were considering doing an opportunity zone project, and I started to get down that a little bit when I realized, well, for one, this project itself just didn't work out. That didn't pencil as well as we would like, which is the main reason why we pulled out. But I started to learn a little bit more about opportunity zones, and as I understand it, you need to, in order to get the credit, you need to put in double what you purchased the property for. Is that correct?
Yeah, something like that. And there's always a lot of strings attached. When when opportunity zones first came out, I was like, ooh, cool, there's a bunch around here, and they're clearly not in the areas that all need the most help. I mean, that was the frustrating thing about it, is like, I'm all for revitalizing neighborhoods that need it, but like, there's a lot of like booming urban downtowns that got these. So it was a strange way of divvying up, our tax money. And then when I did the pro forma on it, it translated to like an extra 6%. over the life of the deal. It wasn't to me something that was at all transformative or even a big factor. Because you're deferring a lot of taxes, and you're hoping that high inflation will eat away the value of what you eventually have to pay. Well, guess what? Inflation's been running hot at 1%, or 1.5%. So you're not going to save all that much, and you're only getting forgiveness of, I think, 15% of your, original tax liability. And that was if your project's already started. Now we're already past the point where opportunity zones can be fully leveraged for everything that they had to offer. So it was a weird program. I think it had some good elements, and I'm sure there's some great projects happening from it. But like with anything, it requires some study, and your accountant will have to, walk you through it. There's extra billing that goes into that. But it can be great, and it can get a lot of investors excited about it. I think it was much more for the investors who get to kind of feel like they're getting a much better deal than maybe they really are. It's not that it's a bad deal. It's certainly better than not having it, but it's not as though you just wipe out 85% of your tax burden. You're just delaying the date of payment.
Yep. So one other thing that kind of jumped out to me when you were talking earlier is you talked about backing out of a deal 48 hours before your earnest went hard. I've gone down into due diligence. So we buy mobile home and RV parks in my partnership, and a lot of times you get down to that wire, and it is hard, especially when you put in, like with these bigger deals, we're putting in months and months of work to identify whether it's a good deal for us. And this isn't just paperwork. It's like flying out to going out to the properties, walking with inspectors, actual work that we have to go and do, all to come to naught, essentially. In fact, it's a negative because we've already spent money on all these different things. So when it comes to due diligence and pulling out of deals, what are the main indicators that kind of that the red flags that stand out to you that kind of say, okay, we have to pull out. This is when I know it's not a deal anymore?
Yeah, that's a great question. And there's some real important things to consider. Number one, I would say, is the human element of either the seller or selling broker playing games with you or being dishonest. And sadly, I think most of the listeners probably realize or have had this experience. Like, it's more common than it should be. I hate to say that, but you got to be very careful of who you're doing business with and the kind of tricks or games they will try to play sometimes. So that's number one, is watching the other side of the table. Like I've only, I think, pulled out of 2 properties that I had under contract. The first one I pulled out of was because the seller stole things from the property that were supposed to be included, in the contract. Like, we had paid for them in the contract, and all of a sudden disappearing. And they thought we wouldn't notice, because a part of this deal was that it was a fully furnished and stocked restaurant on the bottom floor, and there were apartments up above it. And they thought, oh, they'll never notice if I take these really expensive induction burners and stuff from the restaurant. And I was like, I actually have a photo from when we went through with these things here. And, that was the first telltale sign, and it led to other things. And you just kind of realize that the deal isn't sweet enough to put up with that kind of nonsense. If the deal's super sweet, yeah, put up with some nonsense from a seller and a broker, because you only have to deal with them, until the day of closing, hopefully. Don't do seller financing with someone you don't trust, but after that date, you're free to go. The other lesson, I think, is that, I've paid more in due diligence costs than I paid for my MBA, and I've learned more. So you're paying for education. So don't beat yourself up too badly. If you chase a deal, you put some thousands and some, dozens of hours into it, and you decide to back out, because not everything you look at is going to make sense. And sometimes it takes a lot of study and visit and experience to kind of realize if something is good or not. And, so this historic tax credit deal that I pulled out of, I'm really proud of that deal. I think that was actually one of the best deals that I've ever done pulling out of, and the way that I knew it is right after me, they had a backup offer. So the sellers didn't want to negotiate on price. I offered them a pretty high, price. It was much higher than the eventual one they had to settle for, because they had a backup offer. Well, guess what? The backup offer pulled out within, 2 weeks of me pulling out. And then they had another offer, and then they backed out. And they literally went in and out of contract 6 times, because this property was just like a trap. It was a really attractive price for like a prestigious corner building, right in the downtown of this great college town in Maine. Ought to be worth 3 or 4 million, but as soon as you get into it and start peeling the onion and doing the architecture and looking at the cost, like you're spending way too much to get what is actually a kind of small envelope of a building. If you had 100,000 square feet in economies of scale, you can do historic tax credits to great effect. But when you're dealing with 5, 10, 15,000 square foot buildings, you got to be really careful not to get in at too high of an entry price. And that's what this one was. So I don't regret it. It led to great networking, great experiences, a lot of growth. And so I think sometimes it's okay to get out over your skis. It's okay to be uncomfortable with the deal that you're trying to take down. Like, can I really do this or not? Like, those are the times when you're really going to grow as a person and your network. You just need to make sure not to bankrupt yourself or your investors in the process. That's the key. Be willing to pull out, use your brain over your heart, when push comes to shove.
Yep, absolutely. And actually, that reminds me, I'm going to share, this isn't about me, but I'm going to share a real quick story. So we just had a 100-pad mobile home park in Texas that we were under contract for. We got it for a great price on paper. It was 1.2 million, 100 pads in a city in, I'm not going to go into details, but in a city in Texas. It was a good deal on paper. We got into it. We learned, things started popping up. We had all these rehab, a lot of rehab started popping out of the woodwork. They had Orangeburg piping. The electrical needed to be redone. And the seller, when we had first got into this deal, he had said that the rehab was about 300,000. We started getting bids, and it came back, the electrical alone was 700,000. So we went back to the seller and we were like, hey man, look, we're not trying to screw you over. These are our bids. And honestly, you owe 800,000 on this property. That's really as far as we can go, is that 800,000. After that, it just doesn't pencil. And the seller, he said he balked at it. He was like, that is ridiculous. It's blah, 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 blah. But we've been following it, and we've heard people who have gone into contract after us, and they go into the same thing. So when you run into a property and you things come up in due diligence, understand that everybody is going to run into that. And the sellers oftentimes have a distorted view of what their property is worth. And so if these things pop up, know that it's not a deal. You just need to walk away. Especially just knowing that, anybody that does the due diligence is going to run into that as well.
Absolutely. I was just saying to a client today that any data, any information you get from the seller is junk. And it's two kinds of junk. There's two kinds. There's honest junk, where they're giving you their real numbers. And that's what you want, obviously. You want, just to have whatever they actually are getting, but they might be paying double for insurance what you would pay because they didn't shop it. Or they might be having a 10% vacancy rate when yours would be 5%, or all kinds of different features of how they can be overspending on heating and cooling, and you might not. So just because that's the T12, for them, has very little correlation to what it has to be for you and the way you'll manage it, first of all. Second of all, is that there's the other kind of junk where it's sloppy, it's ignorant, it's careless, or it's downright dishonest, where they're just not giving you the right numbers. And it's buyer beware. And real estate is really, sketchy like that, where you've got to be really careful. Any seller number of like, you can fix this up for $100,000 is like, no, probably like just triple whatever they give you in your head. If you're going that's probably about right.
That sounds about right.
So being accurate, maybe you have a different plan or a different idea. So I just take it with not a grain of salt, but a big like honking
barrel of salt. Yep.
Yeah.
Awesome.
Boulder.
Well, hey, Dave, we've blasted through our 20 minutes, so we are at the end of the episode. So I got to push us into the quick question round. This is where I ask quick questions. You give quick answers. It starts with books. Books are my favorite thing to talk about. So I want two recommendations, one for a real estate investing book and one for a general life wisdom book.
Great questions. Real estate investing books. I've kind of read a bunch and I've almost stopped. And I think once you get enough information from those, you can move on to kind of mindset or strategy. So there's two books that I love that I like to recommend. One is Investment Biker by Jim Rogers. famous investor, former partner of George Soros, bought a motorcycle and rode it all over the world, through the Soviet Union, through Congo, Africa, South America, everywhere. And as an investor, and he was buying stocks in all these different stock markets that barely existed at the time. And just his way of analyzing markets and assets and values as he's on this crazy adventure, to me, it's like a must read, really entertaining, really interesting, and a lot of nuggets of wisdom. The other is a great business book called Let My People Go Surfing by Yvon Chouinard, who founded Patagonia. And, great story. And it talks about his MBA management style, which is management by absence, where he would just go and, mountain climb for 2 months and tell his whole team, like, hey, you're the leaders now, lead without me, make the decisions without me. I'm delegating everything to you. And I think a lot of leaders, myself included, really struggle to delegate, because we all have this, I can do it best and fastest myself, so I'll just do it myself. There's that saying, if you want to get it done right, do it yourself. And I think that really holds a lot of us back, certainly me in some cases. So those books, I think, are very helpful for real estate investors, even though they're not the Rich Dad, Poor Dad, which if you haven't read it, go read it. I can beat that horse as well. Those are great books.
Absolutely. Yeah. Rich Dad, Poor Dad. I'm pretty sure 80-90% of the people that come on here say that one. So glad you chose different ones. Next question goes into your habits. So habits are the foundation of your life. If you could point to one habit that you feel has contributed the most to where you are today, what would that be?
Positivity is a huge one. Staying positive and, looking at challenges as ways to grow, building teams. And then you hear a lot of people talking about morning routines and getting up at 4 or 5 a.m. and taking pride in only getting 5 or 6 hours of sleep for years at a time. That's actually really bad for you and really bad for your productivity, for your cognitive abilities, for your stress levels, everything. So my habit is trying to get 8 hours of sleep a night. I'm usually unsuccessful. I have 2 little toddlers. So, if I get 7, it's a pretty good night. But I strive to get that because there's a great book called Why We Sleep, which everyone should read. But if you get good sleep, you're lowering your cancer rates, heart disease, stress levels, everything. It's the best vitamin you can possibly take. So have a morning routine, but make sure it involves getting enough sleep the night before.
Yep. You can get up early, but that means you got to go to bed early too.
You got to be boring, man. That's what it's all about.
Yep. Next question is about location. So what area in the U.S. are you excited about investing today?
Maine. I love Maine. It's where I'm from. It's my own backyard. It's where all my assets are, except I have a property in Bolivia. So Maine and Bolivia. And, in the future, I would invest in Puerto Rico as well. I think there's a lot of tax benefits to doing that. I'm fluent in Spanish. I love the climate, the atmosphere. So I would invest in places that I actually want to be and want to go visit. I know a lot of investors out there are just looking for cash flow markets and demographics and population growth. But there's a secret that I will tell you, which is that you can get an amazing return in your own backyard, even if it's San Francisco, which frankly is on a fire sale right now. So I would actually start thinking about that. But it's because you know the market and you know the people in the market. And if you really devote your time to those relationships, you can do just as well as your own backyard as you can in all the, Austin, Texas's and cash flow markets in the Midwest and South too. So that's just my own feeling, but real estate's such a big field that you can be successful doing it in a variety of different ways. And I'm just someone who loves being able to drive by a building and just kind of know that I own it and know that I made that neighborhood and that block a little bit better for the people that live there.
I love it. Next question is an opportunity for you to brag. So kind of flex your muscles here for a second. What are you absolutely kick ass at? What is your biggest strength?
I think team building is something that I would brag about. I'm really good at, forming good relationships with contractors, and that's huge. And so I hear a lot of my peers, the real estate investors, whining about how and complaining about, oh, I can't get good handyman, I can't get good electricians, they're all too expensive, I can't get good plumbers. Well, guess what? If you pay your people immediately on getting their bills, if you make jokes with them, you treat them right, you treat them like friends and family, and you use them consistently, they will drop what they're doing and run over to your job site. And I feel bad for a lot of other people, because when I call my contractors, they will put other people off because I'm paying, I don't know, a third, a quarter of their annual income. and it just makes sense for them to take good care of me. So that kind of having a team where you find good people, you keep feeding them work, you diversify. So if one's busy or sick, you go to the other and so forth. But it's really important. Don't just treat them like your enemy because you're paying them money and you don't want to spend money. You know, there's a lot of that kind of distrust and attitude that I think is counterproductive.
Yep. I love it. That is great advice. Moving on to the last question, and this one is for the listeners. You've given us a lot of great advice, a lot of good stories to listen to, so I'm sure people want to reach out and get in contact with you. What is the best way for them to go about doing that?
Just give me a call, man. 207-517-5700. That's my cell phone. If I can't answer, leave a message. You could shoot me an email, which is dave@holmanhomes.com. That's also my website, holmanhomes.com. So that's HOLMANHOMES.com.
Perfect. And if you guys want to reach out to Dave, I will put that information in the show notes below. So all you got to do is just click the little more in the description. It'll pop down the full description, and right there, you'll be able to find Dave's info. So reach out, say hi to Dave, tell him he was awesome on the show. Dave, thank you again for hopping on here. Had a blast talking to you. For everybody who's on the show with us today, thank you guys for showing up. You are the reason that we do this, so we appreciate having you here. Again, the best way to support the show is just to subscribe, like, share this episode with your friends and family. Other than that, I hope you guys have a kick-ass week. Keep rocking it in real estate, and I look forward to seeing you on the next episode.
Woo!
Thank you for joining us for another episode of the Real Estate Investing Club. I hope you guys enjoyed the episode as much as I enjoyed putting it on, and we're able to pull some actionable advice that you can apply in your own investing today in the field. Before you go, we have a gift for you. If you're a new investor looking to get started, or an established investor looking to take your investing to the next level, I've created an ebook just for you, available on our website. This ebook will cover how I was able to create both active and passive income in real estate with very little money to start with. In it, I will address the 3 most often cited obstacles new and veteran investors run into by showing you how to find deals that are actually deals, how to finance a deal with little to no money down, and how to exit those deals for maximum value. And if you get the ebook today, I am throwing in a bundle of bonuses, 7 of them to be exact. The first one will be the off-market lead generation blueprint, which will take you through the exact systems and processes we use to generate off-market leads like clockwork, which is the most important skill when it comes to creating wealth in real estate. The second bonus is the A to Z REI systems and vendors guide, which will allow you to peek under the hood of our business and see the exact tools, systems, and even the vendors we use to see the success that we do. And the third bonus is the top 100 best performing keywords pack, which will give you the exact keywords we use to target motivated sellers online using PPC ads. The fourth bonus is our contracts bundle for wholesaling and renting real estate, which will give you access to all the contracts we use in the field to execute all different types of transactions. After that is the Investors Quick Analysis Calculator and Offer Tool, which will allow you to quickly calculate whether a deal is an actual deal and will allow you to create an offer automatically from those calculations. This is a lot of bonuses that I said. I'm just going to keep going down the list. Number 6 is the Investors Daily Success Tracker, which is a tracker you can use to ensure you are taking the right actions day in and day out to reach your financial goals in real estate. And the last bonus is the Wholesalers Template for Quick Assignment Cash, which will give you the templates we use to present our wholesale deals professionally and efficiently to our buyers. Whew, that is a bundle. So it's a mouthful. You get all of those bonuses for free when you download the ebook. All we charge is the admin cost to run the show. So if you're interested in the ebook and the bonus bundle, head on over to the website at therealestateinvestingclub.com. Click on Get the ebook bundle at the top of the page to take advantage of that deal. And with that said, I hope you have a fantastic day, an even better week. Keep rocking real estate, and I look forward to seeing you on the next episode.